Welcome back. So in this video we're going to talk about financial feasibility. Okay? And there's three components: total startup cash needed, financial performance of similar businesses, and overall financial attractiveness of the proposed venture. Those are the three components. Now if you want to know more about entrepreneurial finance or new venture funding or new venture finance, I have a ton of videos on my channel, like more than 100. I encourage you to check them out for a little bit more depth. We're only going to talk about the basic stuff that you need in the financial feasibility analysis piece. So the first thing is you want to be able to calculate the amount of total startup cash that you need and figure out if you can actually get that amount. Now, if you want to look at like break-even analysis and some of that stuff, that's on my channel. Definitely check it out. If you have more questions on it, feel free to post those in the comments below. But basically, you need to figure out how much cash do you need to make that first sale, or in other words, how much do you need to have in your bank account to invest in your business so that you can generate your first dollar in revenue. How much is that going to take? And you know, you need to know that right away, actually, because let's face it, if you only need $1,000 to generate your first dollar in revenue, that's a very different analysis than you need $1 million to generate your first dollar in revenue. So that's something you need to know. And by the way, every bank is going to ask that. So you really need to have that in the feasibility analysis, and then you can expand on that analysis once you get into the actual business plan. Now, I talked a little bit about looking at desirability of specific industries, and that goes into the same thing, looking at the financial performance of similar businesses. You know, you're trying to compare your business to other similar businesses. Okay, so for example, if you want to start a dog food company, you can compare it to other established dog food companies. But you also want to be realistic in your comparisons. You know, the established companies, the really big ones like Purina and that kind of stuff, they're going to have a huge advantage over you because this is an economy of scale. So their profit margin may be X, but you know that your actual profit margin will be much less because you're getting started, right? So you also need to be realistic. Now, if you're not sure about exactly what the profit margins are, you know, we've talked about using Value Line and IBISWorld and BizMiner already in this playlist. But the thing I always tell entrepreneurs, if you want to start a bar, for example, go work in a bar for a little while. Work for 6 months, work for a year. Figure out what you like and don't like, and that'll give you a good feeling of kind of what the books look like. It may not be exact because probably only the owner and the accountant knows, but at least give you some sort of a bead. So actually try working in that particular industry, okay? And ideally, if you have enough time, work in 2 or 3 companies in that industry so you really know what you're doing and you know what you're getting into. And the other thing is you want to look at the overall financial attractiveness of the proposed venture. This is the time to figure out, you know, you're going to be spending 20 hours a day at least on this business, you know, getting it up and moving. Is this something you actually want to do? Is it worth giving up the current paid employment that you have? Is it worth giving up time with family? Is it worth giving away all of these things to be in this business? That's something you need to figure out. Now, there's stereotypical traits that we associate with, you know, attractive ventures. You know, things that have steady and rapid sales growth within the first 5 to 7 years. You hear that with venture capital a lot, right? So that you can sell out in 7 years. Is this a business that's going to have a high amount of recurring revenue? In other words, that once you get established that you can count on a steady paycheck each month. And because of that ability to get that steady amount of pay each month, does that mean that you can also forecast your revenue, right? That's also attractive. Are you able to generate funds internally to sustain growth? And are there exit opportunities? Pardon me. Are there exit opportunities if you just decide, hey, I don't want to do this anymore? A great example is in franchises. You know, a lot of franchises, like let's say you don't want to do Pizza Hut anymore. You know, it's not so easy to just walk away. You know, you have commitments, you have leases, you know, you have the franchise agreement you've paid for. You may have to sell that franchise license to someone else. So you can't just walk away, right? So that's stuff that you need to consider. So if you have any other questions, post them down in the comments below. Definitely hit that like button, if you enjoyed this video, and hit that subscribe button too. I'm looking forward to seeing you in the next video.